Hello, my name is Wiersma, and I am doing my financial analyst research project final report for corporate finance. The company that was assigned to me was Casey's General Stores Incorporated, ticker symbol CASY. Casey's is traded on the Nasdaq Global Select Market. It is considered to be in the grocery store industry within the service sector, as found on the Yahoo Financial page. A little background on Casey's. The company was founded in 1959 by Don Lombardi, who leased the store from his father in Des Moines. After 9 years of operating that store, he remodeled it into a convenience store and then took the advice of his gas supplier and friend, Curvin C. Fish. Curvin suggested that Don buy a oil company or a gas station by the name of Square Deal Oil Company. As you can see in the next slide, Casey's comes out of Iowa with 503 stores where they are founded, and then is predominantly within Illinois with 415 stores, and then Missouri with 318. They've also grown quite a bit throughout the Midwest over the last few years. Economic conditions are certainly going to have an effect on Casey's. These are generally out of their control, of course, but downturns on the economy will cause declines in sales of fuel, which keeps people out of the store so they're not buying their general merchandise and prepared food products. Industry factors. This business itself has low barriers to entry, can be affected not only by other convenience stores but other retailers with drugstores, grocery stores, and also with the advent of club stores like Sam's and Costco. Volatile nature of wholesale petroleum prices, obviously with having fuel as the main product they're selling, they could be affected by disruptions within the supply and spikes in prices. Consumer preferences in motor fuels, this is also an issue. Cars get better gas mileage, and also there are alternative energy sources like electric cars, and the year-end report also talked about the advent of hydrogen fuels, and that's something that they need to worry about. Continuing to look at the industry drivers and risk factors, there's definitely increased expense due to credit cards. As people use plastic, these cards, every time someone uses them, they're going to pick up interchange fees for those. Tobacco products also an issue. Obviously, health issues related to those, so people are staying away from those. Government will also raise taxes on that. So it becomes a very difficult business to be in if you're going to be selling tobacco. Environmental regulations. Casey's is transporting and storing large amounts of fuel, either in tanker trucks across the Midwest and also underground tanks. Unfavorable weather conditions definitely can affect business, from snowstorms to tornadoes, rainy seasons. Bad weather, people don't go to the convenience store. Like many other organizations, protection of sensitive customer, employee, and vendor information is vital. Breaches can have a big reputational risk to the business. Looking at Casey's business model, and next. Location strategy is definitely a big issue for them. With over 1,800 stores and growing, they try to put much of their business into small communities with populations of less than 5,000. And that has worked very well for them as they've continued to grow. They stay away from larger metropolitan areas. Prepared foods is a high margin product that they produce, pizza being something they're well known for, where they make from scratch pizza at 98% of location. They have also dabbled in pizza delivery in some of the convenience store locations that they have. Distribution is also another area where they definitely excel. They want to try to have stores within a 500-mile radius of a distribution center. They are now building a new one in Terre Haute, Indiana, to help keep that distance down between stores and distribution centers. Looking at their revenue sources, in 2014 they had $7.8 billion in total revenues, and that's broken up by fuel sales, which is the largest sector at $5.55 billion, and then grocery and general merchandise at $1.58 billion, and then prepared food and fountain, which is at $0.649 billion. Looking at their competition, one of the things that they say in their annual report is about staying in smaller communities. We seek to meet the needs of residents of smaller towns by combining features of both general store and convenience store operations. Smaller communities often are not served by national chain convenience stores. So within that case, they are able to not only sell gasoline, but groceries and other convenience store items. They also will compete against some restaurants in small towns with the pizza that they provide and other prepared foods, such as cookies and donuts, ham and cheese sandwiches, sausage sandwiches, hamburgers, and cheeseburgers. In the heavily populated areas where Casey's have stores, which they define as 50,000 or more, they're up against national grocery drugstore chains and other convenience stores like Quick Trip that we often see in Wisconsin. One of the things that was also in the annual report is a comparative analysis of Casey's with their stock price against a peer group and also a Russell 2000 index. By starting at a common value of 100 for shares back in 2009, they track that on this chart. You can see the chart, the line that goes up the fastest is the peer group. That's made up of the pantry, convenience stores out of the southeast, Susser Group, which owns a convenience stores in Texas and Louisiana, and then also Alimentron Cochet-Tard, which is a French-Canadian conglomerate that owns more convenience stores than anyone in the world. And there's been a lot of growth in that particular company in the last few years, and you can see how that line spikes up. Although Casey's does quite well in relation to the Russell 2000, and the trend obviously works pretty well for them. Looking at corporate governance, looking at their website under corporate governance, you can see that they are have a strong organizational values which they try to follow, and those can be broken up into 5 areas: honest and ethical conduct, full, fair, accurate, timely disclosures, compliance to all the regulations that they must follow, prompt internal reporting, and this is meant to be in regards to employees and directors, that if they see some unethical treatment or unethical practices, they need to report it, or they themselves will be held accountable for not reporting it. And then finally, they need to be held accountable to the code. So they need to make sure they're following the code. The board itself has 4 subcommittees, and these subcommittees members, directors serve on. There is one executive on the board, and he serves on none of these committees. We have audit, nominating, compensation, succession planning. Each has their own separate charters that clearly defines rules and responsibilities. Here you can see the actual board of directors. Robert J. Myers at the top is the executive. Johnny Danos is the lead director, and you can see that directors are on the different subcommittees of the board. As I mentioned, there is no executive on any of the subcommittees. The directors are independent and comply with experience requirements per SEC regulations. I can find no conflicts of interest with other boards that other directors are on. So definitely find them as independent. Looking next at the financial analysis, by looking at the fiscal year end. Casey's has a fiscal year ending on April 30th, and for this particular report, the end was April 30th, 2014. Over the last few years, there's been an increase in cash holdings. This is primarily to fuel the growth. Cash holdings up significantly, 193% from 2013. Big part of this was $200 million in long-term debt. Revenues increased year over year, 3.8 from 2012 to 2013, and 8.1 from 2013 to 2014. Growth is the big issue here. In 2013, 31 new constructions, 26 acquired. Continues in 2014, 44 newly constructed and 28 more acquired. And in 2015, more growth, 72 to 108 build and or acquire, and then replacing 25 existing locations, and then they should finish in 2015 the new distribution center. So a tremendous amount of growth, updating their facilities, being more compact in those facilities, making sure they have food preparation areas and an environment that's going to keep their customers coming back. Benchmark competitors, the logical choice would be Quick Trip and 7-Eleven. However, they're independently or privately held, so no way to get financials. Looking at Yahoo, they're within the grocery stores group. This is a difficult group to benchmark against. One store that is definitely a good one is called The Pantry. They're based in the southeast region of the United States, known for their kangaroo brands, but they are financially challenged. They were, from an ROA perspective, negative for the last 3 years. Another group our company that I picked was Kroger, primarily a supermarket, but they do have a significant part of their revenue coming from retail fuel sales. Other benchmarks, Susser Holdings was one that Casey's identified. They part of their holdings is Stripes convenience stores out of Texas, New Mexico, and Louisiana. However, could not get financial data. Alimentation Couche-Tard is the other large competitor in this space. They're based out of Quebec, largest convenience store chain in the world. They did try to take over Casey's in 2010, and they will likely acquire Pantry later this month. So when we look at the group I selected, it's the Pantry, Kroger, and Alimentation Couche-Tard were the group. So looking at 4 years of statements, going back to 2011, these are some of the things that I found. Looking at debt ratio, this is an area where Casey's is higher, and I guess by looking at the information I've just reported, really fueling the growth, long-term debt is up for them, so they're quite a bit higher than the industry averages. Interest coverage ratio, Casey's is respectable here. There's a big spike in the industry, primarily attributed to acquisitions taken on and cash being brought into Alimentation Couche-Tard. But then if you take that away, they're very much in line with the industry. Inventory turnover, these are days turnover, turns in 1 year. So there's Casey's is doing a little bit better than the industry. If you look just at the taking out Kroger, which is a supermarket, it kind of levels things out a bit. Looking at asset turnover, and with asset turnover, Casey's is following along with the industry. Seems to be going down a bit in the last few years, but it's definitely an area where Casey's could also do better in this activity ratio. When we look at profit ratios, Casey's does quite well here and separates themselves from the pack, particularly with gross margin. And this could be attributed to how well they do with the prepared food segment of their business, and also being in smaller locations, their labor costs are going to be a bit lower. You can see it again with ROA. They do quite well here. Return on assets, where they are bettering their competition, or at least the industry average, by 36% on an annual basis. Looking next at liquidity ratios, and this is an area that looks to be a bit weak for Casey's. It's weak for the entire industry. If you look at current ratio, the ability to pay, the ability to pay debts, liquid assets, and they are not doing so well here, well below 1. The industry is not doing as well. And then looking at the quick ratio, they do even worse. So you can see here that they are also have a very low number with this. The entire industry would not have enough liquid assets to cover each dollar of current liability, and Casey's trails this. So one of the problems here, if we had an economic downturn and they needed to get cash quickly, they'd take a haircut with having to tap into long-term assets. They definitely wouldn't get what those properties are worth if they had to do that. Looking now into the valuation of Casey's. Here we can, looking at determining the cost of equity, here is the regression analysis in beta. And here we see represented in this chart is the ending stock price for Casey's over a 36-month period, daily ending prices, as compared to 3 years of daily index returns for the S&P 500. Beta ending up at 0.8773, so that would indicate that they are less risky than the market. Moving on to the CAPM cost of equity, using that beta number in this calculation, we can see that the cost of equity was determined to be almost 11% at 10.9%. Here we see growth rate being determined through the sustainable method. Here we come up with a growth rate of 15.9%, almost 16%. And looking at the Yahoo financial 5-year growth estimate, that was at 11.5%. Cash flow per share, here we are determining that. You can see on the screen where we end up with a cash flow per share of 65 cents. Plugging this in then and creating a two-stage model valuation, going through this, we end up with an intrinsic value of $25.68 per share. So this is using the growth rate, the cost of the growth rate that had determined through the sustainable method. If you were to plug in for the growth rate that came from the Yahoo website, we would have seen an intrinsic value of $22.06. Now ready to make a recommendation based on the valuation and the other research that was done. Moving on to that, you can see the closing price for Casey's as of April 30th, 2014 was $68.66 a share, with the intrinsic value determined at $25.68. Given those numbers, I would recommend that Casey's would be a stock to sell. I believe it's rated high, or it's getting a high price. There's definitely perceived value by its shareholders. People see a successful strategy implementation of their locations. Definitely doing well there. That is paying off, and the growth has done well also, where the new stores are getting online and doing quite well. With the growth, they're holding down their costs. With as much growth as going on, they continue to keep those costs down. And again, being in smaller communities, that is going to help with low labor costs. Increased profit margin with the prepared foods, definitely pushing the pizza and the other prepared foods. These types of things, I believe, give the stock price a premium. I'm thinking still sell. Higher debt ratio is something we've talked about. Hard economic times could really hurt them. With the low current and quick rates, it would be hard for them to overcome a big loss with those low numbers. Definitely a good investment for those looking for safe dividends, but I would say to sell and invest in other growth opportunities. Thank you for taking the time to watch my presentation, and I hope you all have a great day.